So today we're looking at hidden liabilities, what investors and CEOs need to know. I get asked this constantly as the markets in different states come up or down. I get lots of calls from investors and future CEOs like, what do I need to worry about? What do I need to think about? And so just at a high level, so first off, the MJ BizCon fact book just came out recently, and they've got a really nice chart in that fact book that shows that if you go back to 2012 and you look at cannabis sales, and this does not include hemp, CBD, and intoxicating hemp products, but every single year national revenues has gone up substantially for the last 15 years, and the projections, it's actually going to start hockey sticking, particularly when we get to federal legalization. And there's actually an article out today. I'll just toss this in here. I haven't read the whole thing, but it looks like Trump is asking for a proposal on legalization. That's good news. Where we are in the Schedule 3 process, if Trump, like he's he's kind of a wild card, but when he says, "Oh, do something," this is something that could actually be done if he wanted to. So he could tell Pam Bondi to sign the document to move cannabis to Schedule 3. All the prep work's done. The HHS gave their review, the FDA, the public comment period, all that's been done. So if he wanted to. And I know from his perspective, he thinks about votes. There's a lot of votes. 8 out of 10 Americans want legal cannabis. It's legal in 47 states. On the Schedule 3 reform, 93% of the public said they wanted it. And so if he's thinking with his voting goggles on, he's probably thinking, yeah, why not legalize this? And he's already said, he was for medical cannabis anyway. So to me, it would be an easy win. It doesn't take any thinking or strategy. Just sign the damn thing and be done with it. If that happens, we're going to see massive gains in cannabis. The existing cannabis companies will go legal. Their tax bill will go way down. Their cash flow will go way up. Their valuations will go up, and we'll see lots and lots of new startups. We're seeing that growth anyway. So the trajectory, if you look at those sales, that kind of where we are, close to 40 billion. Quickly going to 100 billion, it is going to hockey stick upwards, and definitely when you throw in the hemp and CBD stuff as well. So we're growing very, very rapidly. So that means a lot of people want to get in, and they just need to think things through as well. And so when I think, so if I wanted to do the cannabis company or investment, which vertical would I think about? And so you look at the product end. We've got many verticals. We've got farming, we've got chemical processing, we've got retail, and then we've got manufacturing of products, foods, beverages, etc. That would be most enticing to me because that'll still be good 50 years from now, 100 years from now, even when we're fully saturated, fully legal. Same as it is for wine and beer and liquor. You can create your own new vodka today. You can create your own new wine brand today. You can create your own new coffee brand, your own new craft brew, your own new ice cream. If you make a good product that people want, you can be wildly successful. And that will be true forever. And so that's always going to be a good vertical. If you dig down deeper, I think we've all seen this last 20 years. Beverages have just exploded, whether it's hundreds of varieties of water. When I was young in the 70s, we had one variety of water you got out of your faucet. Today we have literally hundreds and hundreds, if not thousands, of variations of water. We have thousands of variations of soda, thousands of variations of craft brew, wines, you name it. The beverage industry is extremely profitable. If you look at types of goods or foods or whatnot you can manufacture, the gross profit margin on beverage is usually at the top of the list. It's very, very high, and so that's why it's very enticing. We're seeing lots and lots of hemp beverage companies right now go very big, so those are very enticing. I think farming and retail still enticing for some time, like the next 5 to 8 years, but I think if you go out 10 to 20 years, it's going to be those two verticals. They're at the either end of the funnel. I think dispensaries, if you go out 20 years from now, is going to look exactly like liquor stores. You go into any city in the U.S., like my town, we've got liquor stores, whatever. Maybe we have 20 of them. We have 100,000 people here, and they're put geographically, per population, and they're all the same. There's nothing special about any one of them. There's no brand. It's just a liquor store. And I think we're going to see that on the retail side because it makes, and more than likely, just like with liquor, you see it going into like my grocery store. I can buy any piece of liquor in my grocery store or maybe the gas station even. So I think we'll see that. So that's not super exciting for me for long term. Same on growing. We'll probably see as it gets real, as the industry gets massive and pharmaceuticals come in, we are going to see, massive farms and, huge companies like whoever, Marlboro or Corona or whoever it is coming in and creating these massive farms to create the most pure strains or whatever. Same on the medical side. I think that'll be very tailored to pharma. They will be studying all these chemicals and these mixtures of chemicals. But I think where you can really do well is on the product side. If you're just making a brand that something is a food, a beverage, something is smokable, a strain, that's always going to be fair game. The nice thing about really farming and manufacturing right now is you get extra tax benefits, and so that's one of the tax things I wanted to look at today. So right now 280E is still applies. It means if your company traffics, a very broad word, and actually not your company, your trade or business, that's what it says, and that's very specific. And this is where the entity games that many cannabis companies like to try to play that don't work. Doesn't matter because 280 says it's your trade or business traffics in Schedule 1 or 2 drug, you get no deductions, no credits on your tax return. And so in Harborside case, they already said, and go Google and read it, they don't care if you have 50 entities or one entity or no entities. They don't care. They're going to look at you and say, wow, Andrew, you and your friends, it looks like you all are selling weed in some way. That means everything you're doing is subject to 280E. So you got to be very, very careful. As a matter of fact, entity structuring can backfire and double your 280E tax if you are not very careful on that side. But again, it's a trade or business. And so this means you could be complete criminal. Just you're selling weed and all kinds of other drugs and you have no business and you make money, you're still required to file a tax return. You're still subject to 280. Doesn't matter if you have 0 entities. So that still applies. These are kind of simple concepts that are often missed. So we want to utilize 47111 correctly. It's a way, even though we get no deductions or credits, we can put a lot of cost into inventory. And what happens when inventory is sold? It becomes cost of goods sold. And the good news for cannabis owners that own farms, processing plants, or manufacturers, inventory is not a deduction or credit, it's a return of capital, and so it is allowed. And so under 47111, this does not apply to dispensaries. For farms and manufacturers, you get a load lots and lots of costs if you're doing correct gap level cost accounting. Most farms and manufacturers are not doing it. You should reach out to us if you don't think you're doing it right, because it is complex and you need to do it right. You'll maximize your deduction and you can get your tax bill down pretty darn low. Now, if Schedule 3 comes through, that's going to be a huge boom for everyone. We're still going to need, you're still a very complex company. So we've already got this on the hemp CBD side. We serve those clients too. They're very complex. They take cost accounting. They're raising capital. They're spending millions of dollars. They're growing rapidly. Of course, they need a world-class CFO to handle bookkeeping, accounting, tax, payroll, software, cap raises, strategic, reporting, all those things that will still apply after 280E. The tax return actually will be more complex, not less complex, so we'll need more insights on that as well. So we want to be really careful on doing tax correctly right now. As a matter of fact, the IRS, so in anticipation of Schedule 3, there were many cannabis companies that went ahead under what I think is bad guidance and what many of my committee members at the AICPA Cannabis Conference think is bad advice, including very prominent cannabis tax attorneys. We had Luke Ortner, chief counsel from the IRS, speak it there as well, and flat out him saying this is a bad idea. And so some of these companies last year were just filing literally a refund. Hey, 280E does not apply, even though IRS says yes it does. They just said, doesn't apply to me because Schedule 3 got approved by HHS, and therefore I'm filing a refund. Give me my money back. Those companies are risking first and foremost, putting a target on your back to get audited by the IRS, which you really don't want. That's going to cost you a ton of money, even if you're correct and win, and possibly a court battle and tons of legal fees. But you're more than likely going to lose. Let me look at this one slide we had from. What did the IRS say? Okay, hold on. I want to. Well, the IRS filed in a brief in December, just a couple months ago, and it said, "Hey, wait a minute, everyone. We're getting some disclosures on 8275 that goes with the refund claim that are not valid." And they call it 280E and 8275, and their quote is, "A review of these 8275 filings has revealed that some taxpayers are taking position of disregarding Section 280E using a variety of rationales that do not constitute reasonable basis." So under 8275, required by law, you have to have a reasonable basis to claim that refund. And by the way, they define, it's not your idea of reasonable basis, it's their definition of reasonable basis. And the IRS is saying flat out, not just a few of these, they're saying all of these. We're seeing a variety of different ideas that are thrown at them with the refund claim. They're saying all of them do not constitute reasonable basis, meaning that refund claim fails, and you're looking at penalties, interest, audits, and whatnot. So we're still, let's just do it right under 47111. Let's minimize the tax burden. Let's not play games with tax refund. We can file protective refund claims. That's different if we have a reasonable basis, which we might. That's Schedule 3. But if you do that, make sure you get a competent CFO on your team before you even think about that at all. What else am I going to hit? Entity structures, let's be real careful. So I still say, especially at this point, you can go either route, flow through entity or C Corp. I think with where we are today, and especially with what's about to come, it looks like on Trump's agenda, it's highly likely we're going to see the C Corp rate drop from 21 to 15% for goods made in America. So that's a huge win to me, even if you have 280E. And so if you're a flow through, you don't get that deduction. Now the old thing that everyone hears on, C Corps, that's double taxation because you got to pay the 15%, and then if you get a dividend, you personally got to pay tax on that. But if you really think it through in cannabis, it's almost never going to be applicable. So most of these startups, they all have the same game plan. We're going to put in $10 million on day one. We're going to launch our farms and dispensaries or whatever. We're going to grow rapidly. It's very similar to high tech, by the way. We are going to, if there is extra money, it's not going to dividends. It's going to go into growth because that's how we're going to maximize our value, and that's the name of the game. We want to maximize our value at exit and full legalization. And so, you invest $10 million up front. You're hoping to get 50 to 100 million on the back end or more. Not paying dividends, that means double taxation does not apply. And you're only paying 15% tax along the way, which we can greatly reduce under 47111. And then if you also structure your C Corp right under 1202, you very possibly could get a massive break at exit on capital gain as well. So there's a lot of incentives to do C Corps. Another biggie, and this has to do what investors need to know. I've seen so many investors burned on this. They didn't think this through. They invested and bought, say, a third of an LLC or a flow through, some kind of flow through S Corp or whatever, and so they had no control. They couldn't say what to do, and the cannabis company operated, and guess what? There was a lot of taxable income on the K1 at year end, and the K1 arrived to the investor's door, and it says, "Wow, you had $100,000 of income. Go pay your tax on it." And the investor's like thinking, "Wait a minute, I didn't get any tax distributions." Called the dispensary owner, "Hey, you need to send me money for my tax." And the dispensary owner's like, "I don't got any extra money. We're broke. We're paying all our money building this company. And by the way, nothing in our LLC operating agreement says we have to pay tax distributions every year." And so we've seen many people get burned by that. And so be very, very careful if you're investing in a flow through. You are going to get K1s. This is the opposite of oil and gas industry where you're going to get a great K1 with lots of deductions. This is the opposite. You're going to get K1 with taxable income, even though you're not getting any money in the mail. So be careful on that. The final concern is audit. If you're an investor in a cannabis dispensary LLC and the IRS audits that LLC, they're going to look at the owners, investors, and guess what? They're going to say, "Oh, whoa, that investor over there, they're worth 50 million. Let's go invest them." That audit can bleed through into the investor other business and income, and I guarantee you there's not a single investor on earth that wants that to happen. And so that's another reason if the IRS audits a C Corp, the audit stays in the C Corp. It cannot flow outside of that. So let's be super careful on that as well. Final topic I have here is MedMen. We talked for years about this. It was just, it just blew my mind for years and years. How do these jokers get investors to write checks for 10 million, 100 million? Never had success ever prior to MedMen running a company. Absolute. It's the biggest fail of a company I've ever seen, maybe worse than Enron. They failed on every front, whether it was sexual harassment or fraud or theft or illegal employment practices. If you can find a law, they broke it 100 gazillion times. I'll just toss this one in. I actually thought the bankruptcy had already happened earlier. It just happened last year, 411 million of liabilities. What a freak show. And then here, this is what's even crazier to me. Not only did these founders have the worst disaster story in all of cannabis, they started a new company and they got investors to give them money. What is wrong with you investors? I mean, seriously. And look how quickly this new one failed. And good gracious, there looks like there's more. Actually, the one I just posted was a documentary, which is good to watch. But then this is the one, these founders. Rapid collapse of MedMen co-founder's latest marijuana adventure. Anyway, it's crazy. So I sometimes have to remind investors, yeah, you want the model to look good. You want to see a lot of revenue growth. You want to see profitability. But you also need to think risk mitigation. You need to think controls, governance, who's minding the store, back house, insurance, banking, merchant services, compliance, HR, accounting, all that important stuff. Make sure you got a world-class dope CFO on your team. Don't be one of these people that puts in money. One of my first ever jobs coming in, this was a long time ago, 2014, my friend who was CEO of a very famous national brand called me. His buddy, who is also the CEO and a billionaire out of New York of a very famous clothing line, called me up. He had written a check for 10 million to invest in his son's dispensary in Vegas, and guess what? It was the most criminal, ridiculous thing ever. He called for me to help him get him out of the deal, which I did. But again, I asked this billionaire, you didn't need to invest $10 million in a dispensary. That was just pure risk. You just added risk, maybe even bringing the IRS to your $1 billion empire. It was just a bad idea, even if it was the best idea ever. If you need to give his son, who's a partier in the music scene, just give him some money if that's what you want to do. But anyway, lots of lessons learned. But anyway, that's all I've got for this week. Thanks for joining us, and I will see you next week.